Hello, hello, welcome, guys. Okay. Check, check. Hi, everybody. Please give me a few moments to correctly set up my chat and other settings. Okay, I think everything is up and running correctly. So, yep, welcome everybody to another webinar of our series. Today, we're going to talk about so-called concept of scenario construction. So, has pretty much nothing to do with technical analysis or fundamental analysis. It's a much more general kind of theme that encompasses both technical and fundamental analysis alongside many other things. The purpose of this webinar, in a sense, is to present the an alternative or a base case kind of rationale that you can deploy when it comes to your trading journey. Okay, so we're trying to introduce what kind of thinking process you may undertake in order to place a correct trade. At least this is from our point of view. This is a biased point of view. This is how we do it. So we came up with a webinar to just introduce this kind of rationale to you. Hopefully, it's going to aid you to come up with a trading strategy for yourself as well, or at least understand and adopt to your trading regime or strategy this kind of mentality, this checklist kind of approach, which could possibly help you elevate your own trading game. So for the time being, this is going to be the main issue of today's um, session. So let's go ahead and begin the whole thing. So again, uh, this webinar is going to be for educational purposes only. There is no investment recommendation or advice in this kind of webinar. So it's purely for educational material only. Okay, so we can read this at your own time. No need. Let's move on to the nitty-gritty details and what the actual webinar is all about. So again, this is the first slide of the presentation. This is an overview of what we're going to go over this in this kind of session. It's not going to be technical. It's only steps and tricks and tricks and techniques, and again, a rationale or a compilation of ideas and things that you um, could incorporate in your own trading in order to elevate your game. Okay. So the idea here is to effectively come up with an actionable trading plan for an instrument of your choice, analyze its current direction, because as we mentioned many times in the past, the most efficient or the most safe way of trading the markets is going with the trend. So identifying the trend from the beginning is something that you need to do. We also are going to go over spotting possible areas where the price action might stall or may accelerate from. We're talking about support and resistance levels, establishing those. Super, super, super simple and basic stuff that if you apply them to your own trading game, you can have much more accurate ways of looking at the price action. Hopefully get ideas of where to enter, where to exit a position, where to wait for the price action to go before buying or selling. So again, this is the purpose of support and resistance levels. We're also gonna try to assess this kind of mental regime anyways, attempting to assess the current momentum or the current strength of the prevailing trend, okay, and see whether it's worth entering the market at this point in time, or shall we expect to, for example, see volatility spiking and momentum or the strength of the trend kind of accelerating from again. Also, we're going to remain vigilant about any possible fundamental factors, something we're going to add into our game to see where the upcoming news releases are in our favor if we have made the best case scenario correctly from the beginning. Remain vigilant about any possible fundamental factors that may impede or accelerate the trend, and finally come to a conclusion or where a sufficiently good entry point as well as an exit point may be set, okay, but also finding an achievable target for an exit, okay. So this is the checklist kind of overview of what we're going to go over in this kind of session, and we are going to begin with some questions. You're going to see them on the next slide, which those questions need to be addressed, okay, in order to come up with let's just say the best possible route going forward with your plan. Okay, so remember, there is no such thing as a quote unquote perfect trade. As traders, we must come to terms with finding the most appropriate trade at that point in time, but that has the highest probability of becoming a reality, okay, at that specific point in time. So from my point of view, there's no such thing as perfect trade. There is I'm not going to name it decent, but the most viable trade at any given point in time, okay? So trading, again, is a game of probabilities. What we need to do and what we are attempting to do in this kind of scenario construction episode, you might say, okay, is to assess as many quantifiable parameters as possible, okay, take them into consideration, and at the end of the day, deploy an actionable strategy that can yield profits, okay? So what we're trying to do is attempt to conceptualize and quantify as many parameters as possible that we can hopefully compute and come up with a probability estimate of success, and whether that is sufficient or not, we're going to take a trade afterwards, okay? What we're attempting to do in this kind of webinar is to outlay the rationale of coming to that step. With the step is the execution. We're going to talk about everything else that comes beforehand, okay? And then we're going to see whether the trade is viable or not. For the time being, we're discussing the rationale, okay? So as I just mentioned, these are a few, some may say there are a lot, but from my point of view, those are a few questions that need to be addressed, okay, in order to create this kind of scenario constructing ability each and every time we do a trade, okay? And by practicing this over time, this whole thing may seem a lot, but over time, you're going to calibrate yourself to go through and each and every one of those steps much more efficiently, much more quickly, and you're going to have much more trained eye for spotting the stuff that you want to see, but at the same time, being able to, you're going to get the ability of discarding the stuff that you need to avoid. Okay, if and only if you have a manifesto, you have a checklist, you have a bullet point kind of checklist that you're going to go over and see, you know what, momentum is strong, strength of the trend is decent, there is the price action is retracing to this kind of specific support level that is decent for me to go and enter the position. If, for example, these three and many other parameters kind of align, okay, then I'm going to go ahead and place my trade. If, for example, I see signals that the momentum is weakening, even though the trend is moving quickly to the upside, I'm becoming a little bit more hesitant at entering the market at this point in time. Maybe I'm going to wait and see on the silence and see how the price action is going to evolve first and then enter the picture. Or let's just say I'm getting divergent kind of signals. Price action is moving to the upside and I see divergent signals arising from, for example, from the RSI or any other given technical indicator that I have outlaid on my charts. and I'm going to be paying attention to this, and I'm waiting. You know what? The price action is moving to high ground, but technical indicators are telling a different story. Maybe I'm not going to go with the market right now. Maybe I'm going to take a contrarian kind of position here. I'm going to go the opposite way because I'm getting divergent signals, or maybe I'm just going to leave the price action to do what it has to do and enter the market at a different time. Discard this current play and move on to a different one. Okay. So we are assessing and we are analyzing each and every kind of play that we have in front of us, come up with a highest degree of probability that, again, satisfies our own biases, and then executing the trade accordingly. Now we're gonna leave it until the part for right before the execution. Okay, so we're gonna go over all these kind of parameters that I personally find helpful when I'm trying to assess whether I'm gonna enter a trade or not. Okay, so some questions that need to be asked or addressed are as follows. So where is the market or the instrument is currently headed at? Okay, this parameter, this kind of question does have a lot of loose ends. Okay, we can we can address this question from many multiple points of view. For example, from a time frame kind of analysis. Okay, what is the macro trend headed at? Okay, is it downwards moving market? Is it an upwards moving market? Is it sideways kind of price action taking place right now? What is the status? Okay, so I'm moving from the macro to long term down to the short or the intermediate kind of trend. Is this short term kind of trend matching the long-term trend, or this is just a pullback? Okay, or this is just a rebound, or this is a technical correction? What is it? I'm trying to identify the state of the market or the instrument at this point in time. Okay, where is the instrument headed at? Okay, this is one question. This, from my point of view, is one of the most crucial ones. So if you establish where the market is headed at with a reasonable high percentage of probability. Okay, so for example, if the market is making lower highs and lower lows consecutively over a long period of time, that's obviously a bearish kind of market, or the negative kind of trajectory of prices are leading me to believe that this is it. Okay, so I'm using my trend lines, I'm using my support and resistance levels, I'm using my channels to make sure that I have the direction of the market correctly, and then I move on to that. So we're looking at market structure, in other words. Okay, where is the market headed at? What is the current trend right now? Okay, so another question is, what are possible points where the price action might find support resistance? So is the price action failing to break from a specific level multiple times? Okay, break above. So that is a solid resistance level. I'm going to outline that. I'm going to highlight that level to have it on the back of my mind, but also visually see that right in front of me all the time to make sure that, you know what, I'm not missing that. Okay, I'm going to be awaiting that the price action is going to move up to that level and it's going to have a hard time breaking up from. Okay, so I'm going to use that information to my advantage from there onwards. If it breaks from that kind of level, I expect that prior resistance level to become a support, which might be on the longer kind of time frame, might be when the price action reverts back towards that prior resistance level, which has turned out to be support. If I see the price action consolidating above the prior resistance level, which has now become support, I'm looking to enter the market because I want to capitalize on the upside since we have cleared this past ceiling, and my analysis points out that the price action is going to head to high ground. Again, we're going to combine, different indications from different technical analysis kind of tools, but also charting analysis tools to make my assessment as the chance of placing my trades much more likely, okay, or at least achieve a high percentage of probabilities. So we're going to do the convergence of indicators there. Okay, another question might be, who is driving the instrument's price? Is it clearly defined? Are the bulls in control? Are the bears in control? Who is in control? Are neither of the two in control? Okay, so we are going to judge that by looking at various different indicators. For example, my personal one that I like to use a lot when it comes to me judging the direction of the market or who is in control, whether the bulls or the bears, on either given time frame. For example, we're talking about long-term, intermediate, or short-term. I like to look at ADX. For me, it's clear as day. This is the most, from at least again my point of view, this is one of the most clear, quote unquote, indicators that make me feel confident about who is in control or judging who is in control. Obviously, that is subject to change given the market is dynamic in nature, but still, that is an indicator that I personally like to use, the ADX, in order to judge that whether the bulls or the bears are in control or neither of them are in control. ADX, for example, is going to tell you that various different technical indicators that attempt to do the same thing, judge who is in control. I've found it with the ADX. No need for me to go on another one. But yeah, you can use whatever you want. Another question that you may need to address is how strong is the current trend? Okay, is there momentum to the on the side with the current trend? Okay, who again is driving the price action? Is it the bulls? Is it the bears? How strong is the current trend? Okay, various different indicators help you achieve just that, judge who is in control. Okay, are there any signs that foretell a shift in the current trend? Okay, do we see divergences from technical indicators that are giving me an indication that, you know what, the current trend has shifted? For example, it might be moving averages. If you have crossovers, most simple way to judge whether, let's just say, a short-term trend has actually has undergone a shift. Okay, from my point of view, a useful indicator is moving averages. Okay, maybe super simple, yes, I know, but it does the trick for me. Okay, using two moving averages and expect to see, or at least awaiting to see, or spotting the crossovers between moving averages, whether that is going to be a bullish cross or a death cross, wherever that is, who is in control is going to be shown by moving averages. So we need to be aware of clues and signs from technical indications or technical indicators. That's why we put them on our chart in the first place anyways, is to give us, okay, the indication that a shift in trend has undertaken. And let's not forget that, for example, moving averages are lagging indicators. They're not telling you, then it's not a crystal ball that tells you what's going to happen in the future. They are compiling information from the past. They are lagging indicators. So if the moving averages do cross over, that means the shift in trend has already happened. No, it's going to happen. It has already happened because it compiles information from the past. They're moving averages. Okay, compiles the averages from the X period of time beforehand. Okay, so keep that in mind as well. So another question is, are there any candlestick formations, major candlestick formations that provide us with additional clues? Did I spot, for example, a morning star on a chart? Okay, what are the implications there? Okay, it's going to be a shift in trend. Okay, well, what is there? Do I have, for example, a print of 3 black crows or 3 white soldiers? Hopefully you remember what that is. We've been over them in prior webinars. Those are confirmation kind of candlestick formations that the trend is going to actually continue where it's actually headed at. So for example, if I see a long green candle, okay, big one, and then follow that by 3 small red candles that do not, okay, eliminate, in a sense, the gains that were created by the big green candle. And then I see the fifth, excuse me, candle being a long green one. Once again, that is a confirmation sign that the current trend is going to continue moving at the established direction. Okay, so this is a continuation pattern. Okay, so studying your candlestick formations gives you extra additional clues of and confirmations or divergences of where the price action is currently headed at way before the technical indicators do, because most of them are lagging. Okay, so candlestick formation are also something that we're looking at. Okay, so are there any available, are all the available technical indicators deployed communicating the same message. This is super important, at least again, from my point of view. I need to see convergence. I need to see all of them telling me the same thing, at least the ones I'm using, the ones I'm trying to, in a sense, assess how the market is behaving or the current instrument is behaving. I need to see them coming together. Okay, it's telling me the exact same thing. The trend is in my favor. The momentum is strengthening. The bulls are in control, and I'm looking. Excuse me, guys. Sorry for a sec. Forgot to place my phone on silent. So yeah, I'm looking at all these kind of technical indications, hoping that they're gonna align. Okay, so if they do not align, I get another picture, which is also good. If they are not aligning, I'm not willing to enter that trade. I need to see them all together, or at least most of them. I'm talking about 6 out of 7, or 8 out of 9. I'm talking about a high degree of probability, or the highest percentage that I can get from technical indications telling me the exact same thing in order for me to be much more confident in placing trades. Okay. If they are not telling me the same thing and I have divergent signals, okay, no need to place a trade. I'm staying on the sidelines looking at price action to get that confirmation that I need before I enter the trade. Okay, so become a little bit more picky when it comes to your trading. Okay, I know you can place a million trades, not a million trades. You can have 10 trades simultaneously and go through a different charts and do your business. I personally don't like doing this. I like to focus on one or two, let's just say 3 max. I'm talking about 1 or 2 most of the time plays each and every time, because I want to have I want them to have my complete attention. I need to pay attention to what the technical indicators are telling me, and we need to consult with my technical indicators and the price action, whether they are hand in hand, and then place trades rather than just opening blindly trades and flipping coins and see, oh, you know what, this is going to go long. I'm going to go long here, and you know what, I'm going to take this position or not. I'm not interested in that. I like to be like more like quote unquote a sniper. I like to focus solely on each and every place in order for me to have, again, to amass the highest chance of probability before entering the trade. Okay, at least that's my style. You can do whatever you want. Okay, so again, are the technical indicators telling you the same signal and taking it to a different level or a different dimension? Yes, for example, in the short term, the technical indicators are in your favor. They all align. What about on a zoomed out kind of perspective from a different kind of time frame? What I'm talking about here is you have a chart of, I don't know, gold or WTI, whatever that is. It doesn't matter. Okay. And you are fixated upon a 4-hour chart. Okay. And all of your technical indicators and price action are giving you the exact same signal. This instrument is going to go, is moving to the upside. I'm going to capitalize on this and go long and capitalize on the rise of prices. Okay, fair enough. What about on a daily chart? Is it giving you the exact same thing? Is it giving you the exact same kind of picture? Okay, on a technical, on a zoomed out kind of perspective, on a daily chart, do the indicators align together, or are they giving you different signals? What about on a weekly chart? Okay, get the macro trend. I like to do the opposite, actually. Go from macro to micro, not micro to macro. Okay, hopefully I'm not confusing you, but you understand what I'm saying? Hopefully you understand what I'm saying. I like to zoom in and out to see, again, that convergence. This is crucial from my point of view. Okay, I like to see convergence of on different parameters all the time at any given time frame. Okay, gives me the highest percentage of probability that, you know what, the trade I'm going to place is going to be profitable. Okay, so are there any divergences that you should be paying attention to? Again, we discussed this many times in the past. We've done what, 3 or 4 webinars in the past where we attempted to spot those divergences, for example, from the RSI or the MACD. Okay, they are telling you what is actually happening. The price action may be making high highs and high lows. For example, price action moving high ground, whereas RSI fails to do that. Okay, as an indication. Okay, maybe it's going to be a reversal in the making. Okay, want to pay attention to that. And if I become trained enough to spot these kind of divergences, you can be a little bit more confident in your game of going against the market. So having a contrarian kind of view. So that's a whole different ball game. For the time being, we're focusing on the simplest and easiest way to deploy a strategy, which is going with the trend. Okay, establishing the trend and playing your game according to that, rather than just attempting to find the tops and short the tops and be the contrarian. No, in the beginning, please manage to become profitable by trading the trend rather than being contrarian. If you are not experienced and you're attempting all the time to go against the market, most of the times you're going to find yourself on the losing side of the equation. Sometimes you may get it right, but most of the times, most likely, unfortunately, you're going to be wrong. Okay, so that's why we structure these kind of webinars to encourage young traders or those that have actually entered the picture in recent times and they don't have the prior knowledge on how the market are working. Okay, the easiest and simplest way to trade the market is go with a trend. Okay, I'm going to say fact, but pretty much it is. If we're not going to brand it as fact, we can brand it as market wisdom. Okay, whatever you want to call it. Okay, from my point of view, it's a fact. But still, now we move on a different kind of dimension. All these kind of questions we've asked so far are concerned with technical aspect of things, the technical analysis. Okay, looking at charts and price action and all that kind of stuff, and deploying our tools. And yeah, now we're gonna shift gears and we're going to look at things from a different point of view, which again, from my standpoint, it's super, super, super important. And it's something that most traders, when they begin, they do not even have the conceptualization that such thing exists. And we're talking about fundamental stuff now. And we're talking about fundamental analysis, looking at economic and financial news releases. What is going on the financial markets beyond the actual price action on charts? Okay, what is the economic environment look like? Okay, on any given market. For example, if we're looking at FX pairs, you're going to have social, economic, geopolitical parameters all coming together that affect the exchange rates between currencies in between countries. Okay, so it is crucial to understand the macro backdrop. Okay, what is, for example, the United States economy going through right now? Okay, on a monetary level, what's going on there? What are the central banks doing right now? Okay, these are events that do affect substantially, okay, the performance of any given thing within the market. Okay, so it's beyond technical. So you look at macro trends and how they are affected by economic news releases. And it's super critical and super important, again, at least from my point of view, to understand how the whole thing works. And if you do understand how the whole thing works, it's much, much, much more easier to gauge the market, where it is actually headed at. And you could spot in advance, okay, possible periods where you're going to have a shift in actual trend of any given thing. Okay, because we're dealing with compilation of information. Okay, for example, inflation prints. Okay, if you look at 5 prints back to back, you're going to get an assessment of where that indication, where that specific aspect, that, for example, inflation is headed towards at. And if you get a glimpse of where it's headed at, okay, you can then assume how the central banks are going to react to this. This was super evident back in 2021, 22, where we saw rising of inflationary pressures. And the only thing you would have expected back then is for central banks to raise rates. What happens when central banks raise rates? Usually the performance of the dollar goes through the roof. Okay, and we're talking about more specifically about the Federal Reserve here. Since this principle is equally applied to any given market. If the central bank raises interest rates, the strength of the country, that specific country's currency, usually most of the times strengthens. Okay, so for example, if the European Central Bank did not raise rates, where the Federal Reserve did raise rates in order to squash inflationary pressures because there is high inflation within the country. There is no other way of looking at things. Euro dollar was supposed to move south. Okay, that means the dollar is going to strengthen at the expense of the euro. So that conceptualization of what was about to happen, okay, gave you a straightaway play from the beginning, shorting euro dollar. That was super, super evident. Same thing with the dollar against the Japanese yen. Federal Reserve raises interest rates. Bank of Japan does nothing. Pull up a chart of dollar yen and you will see what has happened from 2021 onwards. Okay, this is the divergence between monetary policy decisions. This is macro stuff. This is fundamental stuff that certainly affects how the price action of any given instrument, in this kind of case, we're talking about FX pairs, is going to move into the future. Those are the macro trends. So please go ahead and dedicate a lot of time into understanding fundamental analysis as well as technical. Okay, don't fixate upon only technical analysis. Please incorporate fundamental analysis to your trading regime as well, because it's going to give you that extra point of view, that extra factor that, you know what, I'm having at the back of my mind, that I'm expecting, for example, the European economy to underperform over the next few months, given that we have a bad GDP print, continues prints of GDP are dismal. We have manufacturing PMIs, for example, also not performing well. We have the dollar strengthening against the euro, the European Central Bank cutting rates much earlier than the Federal Reserve. This frames a whole picture. This paints a picture that, you know what, the euro is going to be on its back leg going forward. Okay, so if, for example, you are a swing trader or medium to long-term kind of trader, this is all you need besides technicals, obviously. Going short on euro dollar, it's super, super evident based on the performance of the economies. You can extrapolate from there onwards using only fundamental analysis where this specific pair is going to move towards to next. It's clear as day, okay? But it comes with a lot of practice. You need to keep up with these things as they progress through time. So you can watch the stuff I'm doing on a daily basis, on a daily presentation. We are talking about this stuff pretty much every single day, the fundamental aspect of it. Okay, the technical is another dimension that we drove onto as well. But yep, you please go ahead and read stuff, what's going on with the economy, and if you do so, okay, get hints of where the market is headed. No market in general, but each and every instrument. So where we left off, beyond the technical analysis sphere, what microeconomic factors are affecting the selected instrument's price? For example, WTI and OPEC Plus news releases. Okay, for example, OPEC Plus announces, okay, that they will restrict their output capacity in the next 6 months. What do you expect to happen to the price of WTI, of crude oil? It's clear as day, okay? So keeping up with economic and news releases gives you an edge, a significant edge, I must say, okay? So what critical financial news releases are scheduled for the day? And this is for, yeah, pretty much short-term kind of traders. For example, you're trading the markets, let's just say you're trading equities, okay? And in an hour's time, you're going to have the manufacturing PMI of the United States, the S&P manufacturing PMI for the month of June, and the expectation is for it to underperform. What would you reasonably expect to see in equities? Okay, what would you reasonably expect to see happen to the United States dollar if we see underperformance on the manufacturing front of the United States? We expect to see the dollar weakening, most likely stocks capitalizing upon that weakness of the dollar and rising. Okay, these are the stuff you need to go through your day. For example, if you're willing to trade the day to day, please at least be aware. Okay, pull up a calendar and see what is expected to happen today, at least from that economy. okay? And see the expectation. If it's better than expected, okay? If it's worse than expected, okay, how is this going to affect my position? Okay, because the last thing you want to do is open a trade and not realize in 15 minutes time there's going to be an economic news release that topples everything, that demolishes every scenario you have created for that specific instrument. Okay, there's no worse thing than doing that, being not aware what is going to happen in the immediate future. Okay, and in a sense finding yourself on the opposite side of the trade and losing money, and you're gonna scratch your head and say, you know what, everything was perfect. What has happened? No, but what has happened is that you didn't pay attention to what was about to be released. That had the probability of distorting your course of action, your plan. Okay, so please be aware what is expected to be announced within the day, and you will manage, in a sense, your trade accordingly afterwards. Okay, so where did we stay? Okay, are fundamental and technical signals in agreement? Okay, doing that, getting the macro backdrop, and you see the technicals also aligning together. Perfect. Go ahead and place your trade. Are the fundamentals in conflict with the technicals? Pay attention. Okay, do a little bit more thorough analysis. Go through your scenario once again. Right. Is this temporary? Is it going to persist? Are we going to have a reversal? These are all stuff you need to add onto your rationale and your thinking when you do scenario construction. Okay. At least I try to anticipate what might happen. Okay. Or you can stay on the sidelines and wait for the fundamentals and the technicals to align once again and then place your trade. Okay. There's many ways of taking action upon the signals that are outlaid in front of you. Okay, the point is to read them correctly and come up with a reasonable scenario. And then we move on to, once you do this kind of scenario, once you go through your charting techniques, once you put on your technical analysis indicators, once you do your fundamental research, and you see all the signals aligning with your side and you want to place a trade, now, before you place a trade, you need to come up with a profit target. Okay, it's nice having a target. It's essential to have a target. Okay, please avoid flipping a coin and going long or short on any given instrument without setting at least a target. Where do I want to see the price action going at in order for me to close a position? You can use take profit and stop loss orders in that kind of case. Okay, at least have the target in front of you and then place a trade rather than just randomly flipping a coin and, you know, open and close positions. Okay, setting up a reasonable and not reliable, a reasonable and not over optimistic kind of target is going to be super, super beneficial for you. And please go for short, incremental, small gains rather than just awaiting to hit the jackpot with, I don't know, 30, 50, 60, 70% gains on any given stock or instrument. Okay. Big realistic. Okay. Take small portions of the move, realize the lovely profit and move onwards. Okay, small incremental gains are super are, from my point of view, superior to single big shot moonshots kind of trades. Okay, so again, I'm not telling you to do anything. You can do whatever you want. I'm telling you what from my experience has been the most beneficial approach of going at things. Okay, so what is the profit expectation of this particular trade? You said that. What is the risk tolerance of this particular trade? Even more importantly, so how much am I willing to lose if my assessment has been wrong? You need to make sure that you come with an agreement with yourself, in a sense. Okay, so I'm, for example, more inclined to allow myself to lose, let's just say, an arbitrary number, 5%, okay? But I'm willing to gain multiple times higher than that, okay? So what I'm talking about here is risk tolerance or risk-reward ratio. I personally like the 2.5 to 3 to 1 kind of ratios. For example, I'm willing to gain 15% and I'm willing to lose 5%, and I'm coming into terms with myself in regards to that 5%. Okay. For some maybe 2%, for some maybe 10%, for some maybe 15. It's up to your risk tolerance. Okay. And you need to understand this, please, as soon as possible, because this is one of the key cornerstones of your trading. Okay. Becoming familiar, unfortunately so, with losses. Okay. Those losses are part of the game. What you need to do is come to terms with that. We're not going to win each and every trade all the time. Losses are part of the game. What you can do, okay, you can control whether you're going to lose or not. What you can control is definitely how much. Okay. So that is up to your risk tolerance at the end of the day. This is super subjective, and this, it requires a lot of introspection and looking at your way of approaching the markets and coming to a conclusion like that. Okay. So again, what is your profit expectation? What is your risk tolerance? How much capital are you willing to allocate on this kind of particular trade? Okay. You have an account, let's just say, with $1,000, 1,000 euros, 1,000 yen, whatever that is. Okay. How much are you willing to play each and every time? Okay. Are you willing to allocate 50% of your account on a particular trade? Okay. That's one way to do it. Not that wise, to be honest, especially if you're using leverage. For example, a rule not written in stone might be, I'm going to only use at a time 10% of my portfolio, of my equity at any given play. Okay. Maybe that's your rule. Okay. 10% or maybe 15. Okay. It's up to you. You have to come in terms with that. But in order to come with a percentage, a rough percentage of how much money you're going to be allocated on each and every trade, you need to take into consideration how much more you're going to be losing. And therefore, that's why you do this kind of money management kind of thinking and procedure in beforehand before you start placing trades. Okay. So unwritten rule might be 10%, 15% of your capital allocated at each and every trade you place. Maybe you want to risk more and you're going to use 20 or 30%. Okay. At least be disciplined enough to use only that and have reserves in your account in order to safeguard your positions from unnecessary or unwarranted kind of moves. Okay. So money management is another super big and complicated kind of topic that you need to investigate a lot of time coming into agreement. Again, it's you versus you on how much I'm going to be using per trade. Okay. It's up to your risk tolerance as well. So have you deployed the necessary risk mitigation techniques to protect yourself from unwarranted adverse movements? In other words, have you placed a stop loss order? Okay. Again, the name of the game, most successful traders do systematically use take profit and stop loss orders in their game. Again, the purpose is to minimize your losses. This is the only thing you can control in the market. You're not in charge how much you're going to make. Okay, you might say that is the case when you take profit, but the only thing that really matters is how much are you willing to lose, and I'm willing to lose this much in order to get that much at the end of the day. Okay. But beforehand, you need to come up with your plan, execute the plan, etc., etc., etc. Okay. So please use stop losses. They are hassle free, even though if nobody wants to open an account and see, oh, you know what, this position I have undertaken 5 hours ago has reached a stop limit and I've lost, I don't know, X amount of money on this. Nobody's happy when he sees that. The point is, if you pull up the chart and you see what has happened to the price action after you got stopped out, you're going to be thankful to yourself that, you know what, I'm glad I used the stop loss and I didn't leave the position up and running, and I might have lost, for example, 10, 15, 20% and I've instead lost 5%. Okay, so at the end of the day, it's beneficial to you. I'm not gonna sugarcoat it. Nobody likes losses, but small losses are better than large losses, which are gonna compromise and jeopardize your account and wipe it off. So digest that small peel of small losses, and you're good to go. Okay, so have you deployed the listener? Okay, we've gone through this. Did you use all the available tools at your disposal? Okay, so you are familiar, for example, with using technical indicators such as MACD, RSI, drawing trend lines. You use momentum, you use Fibonacci retracement, expansions, and all that kind of stuff, moving averages. Okay, you know how to use each and every one of those. Are you really paying attention to what are these indicators telling you about, or are you using and are you placing your faith on only one of those? In other words, are you discarding? Are you closing your eyes on what are the other ones telling you, which may be telling you a different story, and you're focusing, for example, on your favorite one, which may be, for example, ADX or MACD or RSI? Okay, you know how to use these technical indicators. Please use them in accordance to each other. Use the convergence principle to your advantage. Okay. Do you use all these available tools at your disposal? Do you use take profit and stop loss orders? Yes, yes. You know what a take profit and stop loss is, but are you really using them? Do you actually place a trade and you use stop loss and take profit each and every time? Or are you familiar with the concept? And when the price action moves in the opposite direction, you just find yourself with a wiped out account. Please use the knowledge you have gathered so far. Okay. Put it in action. Okay. Doesn't matter what you say. The point is how you act. So also, did you do your homework? Or you say, you know what, I know what's gonna happen with euro dollar today. I'm gonna go long, and yeah, it's gonna manifest, or it's gonna come to fruition. Nobody cares about that kind of stuff. Do your homework, okay? You know how the whole thing. We've outlined a lovely checklist here and a series of serious questions to go through each and every day when you construct your plan and come up with the most available or most viable action plan that is, let's just say, available at that point in time. Okay, do that. Okay, do your homework, read. Okay, go through the markets, go through charts. What has happened today with WTI? What has happened today with dollar yen? What has happened with this? How is the macroeconomic backdrop moving right now? Okay, what are the indications? What are the news releases are affecting the markets right now? Is there something I will be paying a lot more attention that I should have? Okay, do your homework before start placing trades. Don't just blindly click on buy and sell. This is the worst thing you can do. Please do your homework. Did you go over your trading journal? I've mentioned this in the past few webinars. It sounds weird and boring and bland and banal to have a trading journal. Trust me, if you have an actual trading journal, I mean, we're not talking about having pen and paper and writing, oh, this happened today in the markets. No, what I'm talking about trading journal, this qualifies as well. Taking screenshots, okay, of your trades, of the trades that you have placed so far, okay, and click on a text thing and write what has happened there. I've entered here. My take profit was there. My stop loss was there. What has happened to the market? It moved in my direction. Okay. Profit taken. Perfect. I have an example in my data bank. Okay. Next. Okay. I have a plan here. Everything was converging together. Okay. And the price action was moving in my direction. I was having a good unrealized profit, but something happened and the entire thing wiped my position. What has happened? Okay. Or I missed, for example, today's release of the GDP print of the United States. Okay. It became worse than expected and it has affected this instrument by this much. Okay. Now I'm learning. Next time, I'm going to open my data bank. I'm going to see, you know what? Place this trade. It was perfect. Perfect. It was perfect, but something happened. What has happened? Okay. I've lost money because I didn't check my economic calendar today and there was an unfavorable news release, we wiped out every profit I had in that position, unrealized gain, okay? What did I learn? I'm looking at the calendar next, okay? And once you accumulate enough of these data points, okay, and you have a bank where you can go through each and every day, not every day, but every week, you can go scroll through your trades and see, right, what I've done wrong, what I've done right, okay? What has happened here? Why did I place my stop loss this close? Okay. And you go through this rationale time and time again. Trust me, you are going to be spotting these kind of errors automatically in due time. Okay. The point is you need to put the work in beforehand. And that is why, from my point of view, it's useful, super useful to have a trading journal. Okay. It encompasses your thoughts at that point in time. Okay. But you also spot much more easily your biases. Okay. What am I consistently doing wrong? Okay. If you spot a pattern from your past trades, you can then have, if you will have enough evidence to come to the terms with yourself and say, you know what, I'm gonna stop going against the market. Okay, because I've placed 1, 2, 3, 4, 5, 6, 7 trades against the market and I've lost each and every one of them. Okay, so now I'm gonna undertake a new path. I'm gonna go with a trend, etc., etc., etc. So I'm outlaying you a few examples of how you can use the trading journal. Okay, from my point of view, super beneficial. Please do use it. Okay, so we finish off here by saying the core four aspects, at least from my point of view, is market structure, understand where the market is headed, momentum, how fast is that trend evolving, okay, volatility, what are the conditions right now, what are the things that cause turmoil in this price action, why is it moving so erratically, judge that, and the relative strength, okay, comparing between us. There's a lot of many other things, many other, excuse me, many other questions that you could be asking yourself, but these is a slide with a few of them, okay? So let's move on to the next slide, okay? We mentioned all these questions, all this kind of rationale that is going to be beneficial for you to go through each and every time you place a trade. Let's outline a few examples at your of tools at your disposal that you could be using to check those lovely boxes before entering a trade. Okay, so some examples might be, for example, you try to spot candlestick formations or patterns, okay, which is going to help you to identify the trend. Okay, trend lines also going to be a visual illustration, a visual warning, not a warning, but a wake-up call. Okay, on your chart all the time, you have direction of the market where it's headed at. If the price action breaks below or above the descending or ascending trend line, depending what that is, okay, you adjust accordingly. The point of using trend lines is to have an easy visual illustration of the price action is headed at. Yes, you may say, oh, I can clearly spot the higher highs and the higher lows, or the lower high or the lower highs and the lower lows, okay, which create an uptrend or downtrend. Fair enough. What I'm saying here is please use the trend line to have it clear as day where it's moving. Okay, it costs you nothing. It's just 2 clicks. Click, drag, click. That's it. You have a direction clear as day. And you can do this on multiple time frames. So you go from, for example, weekly charts down to daily charts, down to 4-hour charts, down to 1-hour charts, down to, I don't know, 10 or 15. The point is to see where the market is moving towards to. Okay. The major trend is downwards, but the intermediate trend is actually has shifted. Okay. And maybe we're going to see a reversal. Okay. Now I'm framing myself. Okay. In order to look out for some specific things. And if I don't see others, I'm going to discard the situation. Okay. Again, other tools at your disposal, super simple, free of charge, and easy for you to actually use: horizontal support and resistance levels. Again, super basic stuff, super basic stuff. They highlight the points of friction. Okay. I'm expecting the price action to fail to break above this kind of level because it has failed to do so 5 times before in the past. Okay, so now I'm framing myself, you know what? I'm expecting to see resistance there. So if it fails to break above that level for the sixth time, I'm going to go and place a short order, okay, and capitalize on the fall. Or I'm seeing, have highlighted this point in time where, excuse me, I've highlighted this resistance level where this specific level where price action has failed to break from 5 times in the past, okay? But the technical indicators are giving me the indication that a shifting trend has occurred. Price action is going to move to high ground. Now I'm awaiting for the break above this kind of resistance level, okay? And if it does, I'm going to act accordingly from there onwards. This is the first example I started with in this kind of presentation almost an hour ago. And we're running out of time once again, okay? So again, technical indicators, there's a billion of them. There's a million of them. Please find a few, okay? And I'm talking about 4, 3, 4, 5, 6, depends upon you. But please use indicators that obviously are not telling you the exact same thing. It's telling you, one is telling you about the strength of the trend. One is giving you an indication about momentum. The other one is telling you about volatility. The other one is telling you about the open interest. The other one is telling you about volume, okay? Put all these indications together and see whether they create a puzzle, okay? Do they frame a picture? Do they create a picture? Excuse me. Is it each and every one of them telling me the same story? If yes, high percentage of probability that the trade I'm going to place is going to go my way, okay? That's all I'm asking for at the end of the game, at the end of the day, okay? So technical indicators, use them for gauging momentum, volatility, volume, open interest, all that kind of stuff. Please use them. Again, free to use, super simple to decode. Use them accordingly, okay? So you can add all of these together so far, okay? The fundamental news releases, again, the scenarios we have made many times in the prior slide. Keep an eye on what's going on the international level. If you're not willing to go into the international level, pick a market and focus on that. More information is affecting the related instrument of that specific economy, okay? At least do that, okay? Or at least be aware of incoming economic and fundamental news releases that have the potential to distort the picture in any given way, okay? Again, other tools are at our disposal, maybe the most important ones. Hopefully, if you're doing all the other ones, is take profit and stop losses. Outlined this many times in the past. This is risk management. This is risk mitigation. This is the name of the game. If you want to stay long in this game, you need to start practicing or putting into practice your risk management or risk mitigating kind of techniques and tools at place. Simplest and most easy ones are take profit and stop loss orders. We're not going to go into trailing stops and all that kind of stuff. Concept is similar, but yeah, please use them, okay? It cultivates discipline. It makes you stick to your plan, okay? If you have a plan, hopefully after this presentation you will. If you do, well done. And this is, again, the name of the game from my point of view, at least from the risk management perspective. Also, another aspect is money management technique. We mentioned it as well. Funds allocation. How much money are you willing to trade in each and every point in time? Okay, in each and every trade. Is it 10%? Is it 50%? Is it 20%? Whatever that is, this is subjective. This is up to you. Please use that instead of having an account of $1,000 or 1,000 euros or 1,000 whatever currency you have. Instead of using the entire amount to go and place a trade. Okay, if you want to get burned out, this is the way to do it. If this is your suicide kind of technique to trade the markets, I don't know, go ahead and do it. I'm not going to tell you what to do. I'm telling you, I'm at least attempting to tell you what has been the most efficient way of going at things. So again, unwritten rule, 10 or 15% of your portfolio at each and every trade. It's the status quo or the most basic or default way of going at things. Okay. So lastly, instrument correlations. We're not going to go too much into this. Hopefully, we're going to have a webinar coming up soon about this, talking about interrelationships between instruments. Okay. For example, the trajectory of the United States dollar with crude prices of WTI, okay, or the correlation between bond yields and gold or precious metals, or the relationship between precious metals and stock markets, or the relationships of crypto with stock markets, or relationship of crypto with I'm not going to say commodities. Most likely it's going to be with the dollar. Okay. So there are a lot of instrument correlations that you need to be aware of. If you do your fundamental analysis research, you're going to see that, you know what, there's a pattern behind these things. When bond yields go up, gold for some reason goes down because there is an inherent negative correlation between the two. Okay. We're not going to go, again, into much detail about this. You can keep up with these kind of things. And once you understand how these kind of relationships, which are those relationships, you're going to understand the factors that affect each and every instrument, and by contrast, how it is affecting the correlated instrument. Okay. So in a sense, we use instrument correlations to stay away from trades that do not make sense. For example, go long dollar and go long on WTI doesn't really make much sense because they tend to move in the opposite ways. Again, we're not going to go further into this because we're running out of time. We have run out of time. Last checklist. Okay. So this is an example of a simple scenario construction rationale. Most of this has been said already, but still review the current market conditions and your underlying analysis. Confirm that both of your fundamental outlook and technical signals are in agreement. Okay. You want the merging of the two. You want the convergence. Yes. Evaluate why you have dismissed opposing information. If fundamental data tells you the market is going to move, that specific instrument is going to move to the south, that means decrease in value. Why are you creating a scenario where you're favoring a long position? Makes no sense. Okay. So you need to calibrate the two in order to make sense. Identify key support and resistance levels to pinpoint optimal entry and exit points. Yep. Specify the price level at which you plan to enter the trade. It doesn't mean that you have identified the potential promising trend that you can capitalize upon of any given instrument. And if you do, that means, oh, you know what, everything is telling me go long. That doesn't mean I'm going to go long instantly. Okay. You need to understand that you need to put into the equation that there are better prices that you can actually enter the picture. For example, I wait for a small pullback. Okay. Price action to, in a sense, revert a little bit back before entering a long position. Those are nitty-gritty details that come with time, but still, that's something else you need to pay attention to. Establish a realistic take profit order. Please do not use exuberant or utopian kind of target levels. Most of the times they don't come into fruition, and you see the position, yes, gaining money, but after some time, momentum wins out and price action moves to lower ground. Could have exited the position when the trend was strong and re-enter the position afterwards. Okay. So again, this comes with time. This comes with practice. Set a stop loss at where trade is no longer aligning with your initial analysis. So if it doesn't go my way and breaks below this kind of trend line that I have placed or a support level that I have placed, I'm going to close my positions. Therefore, I place a stop loss order there and I have ease of mind, and I'm going to move to a different chart despite losing a few percentage of your money. For the long term, this is a viable strategy. Determine how much you're willing to lose in a single day. Again, risk management. Adjust your position size, that position losses align with your predetermined risk tolerance and budget. Okay. This is the risk reward ratio with money management technique. Okay. Willing to use 10%, and I'm willing to earn from this kind of allocation, let's just say 20%, and I'm willing to lose 7. Okay. Again, this is up to your risk tolerance. So enter the trade once the price reaches your entry level, and these are what we call setups. We're going to use, and we're going to look at that on the next webinar. We're going to do a quasi live trading session where we're going to go through the whole thing and set or possibly set pending order at that point price. Okay, so yes, the price action is moving to higher ground. I'm not willing to chase this. Okay, I'm placing a pending order below the current price. Let's just say 5 or 10% lower than the current price. If the price action and when the price action retraces, because most of the times it does retrace, I'm going to get that point in time. I'm going to get that entry point, which is much more optimal compared to what it was. Okay. Pretty much simple. So finally, oh, yep, there is a slight missing here. Never mind. Okay. Hopefully we're going to use it on a different webinar. There was supposed to be a slide there with a visual checklist of stuff. Anyway, I'm going to leave it at this. So a lovely quote that I personally like a lot. This is from the legendary John Bollinger, and you can use this kind of quote when it comes to your trading style as well. So when there is low volatility is where trends are born, and high volatility is where they go to die. So in a sense, this tells you that it's much more profitable for you to spot periods of trendless market conditions. And once the first initial signs that the pattern, the sideways motion is interrupted, and you see clear signs that the price action is moving to higher ground, you capitalize upon that rally. In a sense, you position yourself early in the rally, not in the distribution phase, but in the accumulation phase, where the price action tends to rally quickly and swiftly from the past trading range, and capitalize upon the high volatility for exiting your position in the time at the time, in a sense where you can clearly see that this instrument has rallied a lot, and you know what, from here onwards most likely we're going to see a reversal. Okay, so again, a lovely quote to finish the webinar. Okay, so guys, if you do have any questions, please send them through before we go. For the time being, there is not much else to say about this lovely webinar. I was intending to go in a live environment and look at this all together. Unfortunately, we are running out of time. We have run out of time. I'm going to leave it here. No questions in the chat. So we're going to leave it here. Thank you guys for watching. See you hopefully next week. We're going to do a live session. Have a lovely weekend. Okay. Take care. Bye-bye. Bye-bye.